In this video, I am going to analyze companies which are in steel sector, and most of them are large cap steel manufacturers. Kalyani Steel is the medium term or medium scale industry. These companies manufacture steel and steel products. We are comparing Tata Steel with the other group companies and will rank them as per their fundamental scores. Tata Steel's current market price or the last closing price of the stock was 510 rupees, and it was down 21% from its 52 weeks high. So this particular ratio, the down percentage, measures how much the stock has fallen from where it was 52 weeks back. JSW Steel price has fallen by 35%. Other group companies too have fallen at a similar pace of 29%, 37% for SAIL, and 24% for Welspun Corp. Here, the lower the fall, the better it is, and higher the fall, the more weakness the stock has. Market participants or the investors have sold shares, and the price of the shares has gone down considerably from its 52 weeks high. Let us look at the company's earnings per share in the last 12 months of data that is available with us. This is the earnings per share during the last 4 quarters. Tata Steel earned 83 rupees per share. Other companies like JSW earned 31, Kalyani Steel earned 30 rupees per share. SAIL had earned just 5 rupees per share. Welspun Corp in fact had a loss per share of 50 paise. Next, let us look at the earnings yield. This ratio measures the profit which is earned on each share against the current share of the price. So for example, if the current price was 510 rupees for Tata Steel and the company has earned 83 rupees on that, so that translates to 16% of earnings yield. JSW's earnings yield was 11%, Kalyani Steel's earning yield was 14%, SAIL managed to have a 10% of earnings yield. These are very good earnings yield for these companies. Welspun Corp again, since it had a loss per share, its earning yield was negative at 0.36%. Let us look at the price earning of the 12 months. This ratio basically helps us understand where the price is in terms of earnings, or when we compare price and earnings, the multiple that we are paying for that earnings is measured by this ratio. In this ratio, we take the current market price and divide that by the 12 trailing months earnings. So this PE ratio basically helps us understand how many times more are we paying for the earnings of the company. Tata Steel, we are paying 6 times more than the earnings. The earnings was 83 rupees per share in the recent 12 months, and investors were paying 510 rupees for that share. So that works out to a price earnings multiple of 6 times. Here we want it to be as low as possible. JSW's PE multiple was 8 times. Investors were willing to pay 8 times more than the earnings of the company. Kalyani Steel was available at 7 times its earnings. SAIL was available at 9 times. Welspun Corp had a negative price earning, that is why we have kept it blank here. Next, let us look at the price earning multiple investors were willing to pay in terms of last year. That is, the price is of the current year, but the earnings value is of the last year. Here too, we want it to be as low as possible. Tata Steel was available at 4 times its price earning multiple. JSW last year's price was 13 times higher than its earnings. Kalyani Steel's price was 8.2 times higher than its earnings. We don't have the price earnings ratio of last year for SAIL because they had a negative earnings. So whenever we have a loss per share, we don't have a price earning ratio. Welspun's price was 23 times higher than its earnings. So here we want the price earning to be as low as possible, whereby we don't pay a very high price for the company's share in terms of its earnings. Let us look at the historical 5 years price earning value and 3 years average price to earnings ratio that the company has been trading at. Even when we look at 5 years historical price earning multiple that the prices were trading at, Tata Steel's price was 7.6 times higher than its earnings, whereas in the last 3 years on average the price was trading 4.4 times its earnings. So the current price earning is quite justified, and the latest price earning is slightly above the 3 years price earning and below the 5 years price earning multiple. So in this way we can cross compare the latest price to earnings ratio with its averages as well as how it was in the last year. JSW's historical price earning for 5 years was very high, wherein the price was trading 30 times higher than its earnings. In fact, in the last 3 years, the price or the earnings have either fallen or increased to come to a ratio of 15 times. The current price earning multiple, this is the latest one, is 8 times, which is below the averages, which is a good sign. Kalyani Steel's 5 years and 3 years historical price earning had been very nearby at 7.2 and 7.9 times. Even the latest earnings, price earnings of 12 months is around 7. So this is a very good price earning multiple to accumulate the shares. SAIL's historical price earnings were high at 13 times and 14 times, whereas the latest price earning has come to 9.9 times. Again below the average, so it can be considered a good price earning multiple. Welspun Corp's 5 years historical price earning as well as 3 years has been very high at above 33 and 36 times. The latest 12 months price earning multiple is not available because the company had a loss per share of 50 paise, which translated into 0.36% per share at the current market price. So if we look at the down percentage, Tata Steel has fallen the least at 21% from its 52 weeks high. The most fall was seen in SAIL at 37% from its 52 weeks high. In terms of earning yield, Tata Steel has earned the highest return on its price at the rate of 16%, and the lowest yield, in fact it was negative, a loss of 0.36% for Welspun Corp. The latest 12 months price earning multiple, which shows that how cheap the stock is, was again for Tata Steel available at just 6 times, and the most expensive again was Welspun Corp, where the earnings were negative. So whatever price we pay, basically we are paying for a loss making share. In terms of latest price earning multiple of the last year, again Tata Steel was available at the cheapest price earning multiple, and SAIL had a loss last year per share That therefore it had a negative ranking. In terms of historical 5 years price earning, the best available script was 7.26% Kalyani Steel, and Welspun Corp was the most expensive at 33 times. Since last 3 years, the price earning multiple for Tata Steel was the best, available at just 4.4 times its earnings. Welspun again was most expensive at 36 times its earnings. Next, we'll look at the current market price to the operating cash flow. This particular ratio compares where the price is against the cash earned by the company through its operating activities. Tata Steel's price was 7 times higher than its cash earnings. Now, the difference between price earning and cash earning is simply that the price earning considers in the earnings all expenses and income, whether by way of cash or non-cash, whereas cash earning considers only cash inflows and outflows out of the business through its business operations. JSW's price was 5.4 times higher than the cash. Here too we want the value to be less than 25 times. And if the price to cash is lower than price to earning, that would be much better. So if you have to compare here, 12 months price earning was 6 times and price to cash was 7 times. So what I'm looking for is that the price to OCF ratio to be even lower than the price to earning. In that way, we understand that whatever the company's earnings is earning, that is getting translated into cash. JSW's price earning was 8 times, whereas price to cash was just 5.4 times. So this is what we want to see, that the price to OCF being lower than the price earnings multiple of the 12 months. Kalyani Steel's price to cash flow ratio was 4.9 times, whereas price earning was 7.13 times. This basically tells us that the company is earning more cash than what it showed as earnings or profit. Sales price was 3.5 times higher than its cash earnings, which is very good, whereas price to earnings was 9.9 times. Here, Welspun Corp had a loss, so we didn't have the price earnings ratio, but we have the price to cash ratio, which is 3.8 times. So although the company showed that it had suffered losses in the recent 12 months, but last year, this value is of the last year. Last year it had made a cash earning which was just 3.8 times of the price, whereas last year the price earnings was 23 times and the price cash was 3.8 times. We'll look at the price to free cash flow. This particular ratio measures where the price is in when we compare it with the free cash flow of the company. The free cash flow is the operating cash flow less whatever investments the company have done in buying of fixed assets, plus we add back whatever assets the company has sold. So we have the free cash flow, which is to be distributed or can be used for distribution in financing activities. Tata Steel's price was very high in terms of free cash flow, because here when we see such a high ratio, it means the company's free cash flow is minimal. The company doesn't have a very high cash flow. Although the company had a very good operating cash flow, the free cash flow was negligible, which we will see when we go down and check other ratios of 5 years. So we don't want the free cash flow, price to free cash flow to be more than 25 times, same like price earning and price cash. JSW's free cash flow to price ratio was just 8 times. That is, price was higher by only 8 times of its free cash flow. Kalyani Steel's price to free cash flow was 5.9 times higher. SAIL had a negative free cash flow. That is, the company has spent more cash in their investing activity than what it earned through its operations. So this is not a good sign. Welspun had spent very little of whatever it earned in cash through operations in its investment activity. So the price to free cash flow was just available at 4 times. So we want it to be as low as possible. Next we'll look at the price to book value. This ratio compares the price with the net worth of the company. Here we are looking at what the share is actually worth as per the company's book or as per the company's records, and what the market participants are quoting the stock at, or what valuations the market participants have given to the stock vis-a-vis what the company is saying the share is actually worth. This is in nutshell the price to book value. So here we don't want the price to book value ratio to exceed 2.5 times. That is, we don't want to pay more than 2.5 times of what the company is saying the share is actually worth. Tata Steel's price to book value is 0.83. That is, it is available at a discount to what the company is quoting its shares are valued. JSW Steel's price is 1.9 times higher than its book value. Kalyani Steel is also very nearby to its book value of 1.06. SAIL is again trading at a discount of 0.57 to its book value. These are good opportunities to buy into company when the company's shares or at the market price falls below its actual value of the share, but provided the other fundamental ratios are intact and we can rely upon those, and then only these ratios would matter. These are the valuation ratios which help us understand where the price is vis-a-vis different variables. Welspun Corp's price was 1.3 times higher than its book value. So all these are trading below 2.5 times. Next we'll look at the price to sales. This ratio basically measures what was the total sales of the company, or we can even look at it in terms of per share basis, but for time being we'll look at the total value. Assuming the company has made a total sales, that sales we have to compare with the market cap of the company, how much the company is valued in the market against its sales of last year. So here we want it to be as near to 1 as possible. The price should not, or the market cap should not exceed a high multiple of sales. Tata Steel's market price or total market capitalization has fallen below its sales. So here we have high sales compared to what the company is actually worth in the market. So the company is actually selling more product, or more of its products are being sold than what the company is actually valued at. JSW Steel also is selling more than its market cap. Same is the case for Kalyani Steel. In fact, most of these companies' market cap has fallen extremely low, where it has even till a point that the sales have exceeded its market cap. So this is again a very good valuation metric that we can look at to understand where the price is. To recap, in terms of price to OCF, the most expensive was Tata Steel, where its price was 7 times higher than its cash from operations. The lowest price to cash multiple was of SAIL at 3.5 times. In terms of free cash flow, the most expensive was SAIL, where it has spent more in investing than it earned in cash. So that was negative 47 times. And the best available in terms of free cash flow was Welspun Corp, just at 4 times its free cash flow. In terms of book value, The most reasonable was SAIL, available at a discount of 0.57 times to its book value, and JSW Steel was the most expensive, trading at a premium of 1.93 times its book value. In terms of sales, JSW is the most expensive, where its market cap was 0.79 times its sales, and SAIL had maximum of its sales to the price or the market cap of 0.32 times. That is, the market cap had fallen below the sales by 0.32%. Next, we'll look at the profit growth rates of the companies in 5 years and how it has performed in last 3 years or over last 3 years. If the base price for comparison of the growth is negative, we will not have any value in the list. So Tata Steel's 5 years back, whatever loss they had, due to which we could not calculate the growth rate. Similar is the case for 3 years. 3 years back also Tata Steel had a loss, net loss, because of which the calculation could not be performed. Same is the case for SAIL, where both 5 years and 3 years back the company had losses in their profit and loss account, and Welspun Corp also had loss 5 years back. Only Kalyani Steel and JSW had managed to have a positive profit rate or value, because of which we could calculate the profit growth rates. JSW has grown its profit over a period of 5 years at the rate of 42%, and in the last 3 years the profit has grown at a phenomenal 104%. This needs to be looked at because such high growth rates are little difficult to achieve. This could be due to exceptional items or like sale of fixed assets or something like that, which could translate into high profit or a one-time gain. So whenever we see these kind of high growth rates, we have to be little cautious in taking it into calculation. So we'll just give it a 1 mark regardless of whatever the value is. Even if it's the highest gain, we'll just give it a 1 mark. Kalyani Steel's profit had been growing at 36% over a period of 5 years, and in last 3 years it is much reasonable growth rate of 11%. Generally we should be satisfied with a growth rate of 10% compounded over 5 years or compounded over 3 years. And Welspun had a growth rate of 23% over a period of 3 years. Next we'll look at the PEG ratios. PEG ratio basically is price earnings divided by the profit growth rate of 5 years. This ratio helps us understand whether the price earning multiple which we calculated earlier is that fair and is that low enough for us to pay. The way that to understand is, if we are paying say 10 times the earnings of the company, we want the earnings to grow every year so that we can recover our initial investment much faster. If there is no growth in the company's earnings, then the 10 times we paid would basically mean that we'll have to wait 10 years just to recover that money that we invested. But if there is a growth in the company's profits year on year, then we can expect to not wait for 10 years and maybe recover it much faster, let's say in 7 years or 6 years, depending on the growth in profit. So we have in this ratio price to earning of the recent 12 months, and we take the profit growth rates of the last 3 years and try to extrapolate it over the future growth rates. Since the price earnings of Tata Steel was not available, or in fact we didn't have the profit growth rates of the 5 and 3 years, we could not calculate the PEG of both 5 and 3 years. JSW's PEGs for both 5 years and 3 years were 0.21 and 0.08. We want these numbers, PEG numbers, to be below 1.5 times and above 0. What this signifies is that whenever the ratio is between 0 and 1.5, it shows us that we'll be able to get our capital that we invested much faster. Kalyani Steel's price earning PEG ratios were also good at 0.19 and 0.63 times. The other two companies, SAIL and Welspun Corp, too could not be calculated due to either no values in the profit growth rates or having a negative price earning ratio, or basically a loss in that company. Next, let us look at the sales growth rate over a period of 5 years and sales growth rate over a period of last 3 years. These are the compounded values. Tata Steel sales have fallen at the rate of 0.38% from where it was 5 years back. So a mild degrowth in sales, that's okay. We don't want a very high fall in the sales rate. In fact, in last 3 years, the sales has fallen at a slightly higher rate of 1.79% every year. JSW Steel had a growth rate of 12.94% since 5 years and a slightly lower growth rate of 9.85 over a period of 3 years. These are good growth rates. We want the sales also to grow at above 10% year on year. Kalyani Steel also had a good growth rate over a period of 5 years at 10% every year, whereas in the last 3 years the sales growth rate has fallen to 3.1%. We want the sales growth rate to be above 10 for both the years of comparison. SAIL managed to grow its sales at 5% over a period of 5 years and 8% over a period of 3 years. Welspun had a fall in its profit for both 5 years and 3 years at the rate of 3.6 and 3.7%. We don't want to see a fall in sales from where it was 5 years back or 3 years back. Welspun Corp had the highest sales drop over both 5 and 3 years period, whereas JSW Steel had the highest growth in its sales for both 5 and 3 years. Next, we'll look at the return ratios, RoE, that is return on equity, and return on capital employed, then return on assets, and that how that assets were turned over into sales last year. Then we'll also look at how the company has performed in terms of its invested capital. I'll explain each term as we go through these ratios. Return on equity basically measures what was the profit that the company earned on the shareholders' money. This ratio gives us an average value of the return on equity. Here we want the RoE over a period of 5 years on average to be above 15% at least. Only Kalyani Steel has managed to give an RoE of above 15%. Sales last 5 years had a negative RoE. We don't want to see these kind of value. In fact, over a period of 5 years, the company has been giving losses to the shareholder. In fact, it is making losses on shareholders' money at the rate of 1.54%. Tata Steel has been earning very less profit on the shareholders' money at just 0.02%. And Welspun Corp also has not earned a lot, in fact just 2.86% on the shareholders' money. Only JSW Steel and Kalyani Steel have managed to earn a decent RoE over a period of 5 years on average. Let us look at the current return ratios, whether it has improved over its average. The RoE basically measures how much profit a company is generating with the money shareholders have contributed. In the last year, that is 2018 or 2019 value, or the latest year's value, Tata Steel has earned 11%, JSW Steel has earned 25% RoE, Kalyani Steel's RoE has in fact slightly decreased to 15%, SAIL again had losses on the equity shareholders' money, and Welspun Corp managed to increase it by just 5.36%, but it is still very, very low. Let us see how the RoE has grown over a period of 5 years. From where the RoE was 5 years back, has it grown or has it fallen down or has it reduced? Tata Steel's 5 years back had a negative RoE because, as we saw earlier, the company had made losses 5 years back. So we don't have the ratio here. Same is the case for SAIL as well as Welspun Corp, which made losses 5 years back. JSW's return on equity has grown by 31% year on year, whereas Kalyani Steel has managed to grow its returns on equity at the rate of 17%. We want a 10% growth rate in equity, or even if it's 5% growth rate, it is still okay. Next, let us look at the return on capital employed. This is the profits that the company is generating on the total capital employed into the business. Let us see what is capital employed into the business. It is calculated by adding up fixed assets that the company owns, and we also add to that the working capital of the company. In short, we are trying to understand on the total capital that is employed into the business, what is the profit that the company is earning. Now this profit is basically the EBIT, earnings before interest and tax, and not the net profit. So the return on capital employed should also be above 15%. So let us look at how the company has done in terms of RoCE on average over a period of 5 years. Here too, we see only JSW and Kalyani Steel have managed to grow its RoCE at a double-digit value, and all the other 3 companies have lagged behind with a single-digit growth rate. In fact, SAIL's return on capital employed is very poor for a period of 5 years at just 0.61%. So we would definitely not want to invest in a company like SAIL because it is not earning profits on either the shareholders' money or whatever it is deploying into its business. Tata Steel's RoCE is 6.3%. Even Welspun Corp's RoCE is 6.5%. Kalyani Steel managed 22% of returns on its capital employed. This is the operating profit that we are considering in terms of capital employed into the business. Let us look at the current RoCE that the companies have earned. Tata Steel has grown its RoCE above the average at 12%. JSW has managed 17% of RoCE, Kalyani Steel 19%, and the other 2 companies are in single digits, SAIL as well as Welspun Corp. So these are not good values for SAIL as well as Welspun Corp. Now, we also have to see whether the current year's RoCE is above the average. Our Kalyani Steel's latest RoCE has fallen below its average, but it's still very high compared to the peer group companies. We also have to understand this is a small cap company, so there are likelihood chances that it may earn a high RoCE and RoE in its businesses. Whereas Tata Steel is a very big company and it could be working with high volumes instead of high margin. Next, we'll look at return on assets. Now, this is over a period of 5 years on average. Now, we have to understand first of all what is assets employed into the business. This is the total assets and we reduce the current liabilities from it. The current total assets composes of all the assets that the company owns, and whatever current liabilities are, we remove that out because we don't want to duplicate the current liabilities into the assets of the company and increase the total assets value. Here we want a value to be as high as possible, preferably above 5% at least. Tata Steel had a negative growth rate in its assets. Even SAIL had a negative return on assets, that is, whatever assets it employed into the business, it was not able to earn any profits on it. Only Kalyani Steel and JSW have managed to earn a little bit of RoA at 4% for JSW Steel and 12% RoA for Kalyani Steel. Next, let us check how the assets were turned around or turned over into sales, or how many times over the assets were turned into sales. This assets here composes of net worth of the company plus any borrowings, that is equity shareholders money plus the borrowings that the companies have done. So here we want the ratio to be as high as possible so that we can understand how the assets are getting converted into sales and at what multiple levels. Tata Steel's sales were lower than the assets deployed into its business. Its sales were just 88% of its assets. JSW has managed a high sales of almost equal to what it had as its assets employed into the business. Kalyani Steel too has managed to grow its sales by 1.41% above its assets. SAIL has less sales than its assets. Its sales were 71% of its assets. And Welspun Corp too has managed a high sales growth rate in terms of its assets. Now here, all these numbers may seem very plain and absurd to look at, but when you really understand the meaning of the ratios that you're checking and then look at the numbers, it gives you a very good idea about the company's character or what the company is doing in terms of its sales and profits and returns as well as valuation. But just plain looking at numbers would not make sense to anyone who is looking at this video. But to me, it creates a very good picture of the company. But for that, you have to understand the meaning of each ratio that you look at. Each ratio is very helpful in understanding what the fundamentals of the company. Next, we'll look at the return on invested capital. Here, the returns is the operating profit of the company and we divide it by the invested capital. Now, what is invested capital? It consists of the net block, that is fixed assets, but we remove the depreciation from that and we add the working capital. Now, working capital is basically calculated by subtracting current liabilities from the current assets. Or we can say current assets minus current liabilities plus the net block to calculate the invested capital. Tata Steel has earned 17% on its invested capital. Here what happens is, in this ratio, the difference between return on assets and return on capital employed too, we see a very low values here, but ROIC is very high. That is because ROIC does not consider or reduces the depreciation cost from the fixed assets. So basically we have a denominator which is very low. But here these companies are very high capex intensive. They need a lot of capital expenditures, because of which they have a very high depreciation cost, and due to that the earnings generally fall and we don't get a good ROE ROCE ratios. ROIC basically helps us understand that if we remove of the depreciation, what is the return on the company's profits. So Tata Steel ROIC is 17%, JSW is earning 26% ROIC, and Kalyani Steel is earning even higher at 30%. All the ratios improve the moment we remove the depreciation out of the calculation. The depreciation cost for many of these companies may be very high, even for SAIL. If you look at the RoCE, and in fact ROE was negative, but ROIC has turned positive. That is because these steel companies need to invest a lot in their fixed assets, because of which, as I explained earlier, there is a high depreciation value that needs to be deducted from its earnings. So in terms of return ratios, ROE 5 years average, we see that Kalyani Steel has done the best, whereas SAIL had a negative ROE over a period of 5 years on average. In terms of latest ROE, JSW Steel has done the best at 25% on the shareholders' money. Again, SAIL had a negative earnings or losses on the shareholders' money even last year. In terms of growth rate in equity, both Kalyani Steel and JSW Steel have done well. RoCE growth rate of 5 years was highest for Kalyani Steel at 22%, whereas SAIL had a lowest RoCE of 0.61%, that is on the capital employed into the business. The latest RoCE 2 for SAIL was not good at just 2.6%, whereas Kalyani Steel had the highest returns on the capital employed at 19%. In terms of return on assets too, Kalyani Steel did the best at 12%, whereas SAIL had a negative return on assets. This is due to losses that the company has made over a period of 5 years. In terms of asset turned over into sales, SAIL again was the lowest one, where its sales were just 71% of its assets. The highest sales to assets turnover was by Welspun Corp at 1.78 times. Finally, looking at the return on invested capital, Kalyani Steel was the best at 30% on whatever in capital was invested into the business, less depreciation, and SAIL has done very poor at just 6.38%. Next, let us look at how the company has converted its profit over a period of 5 years into cash, and how much of that cash has been used in investing through free cash flow. So we'll use the comparison of the cash flow with profit after tax and then free cash flow with the cash flow from operations to understand how the company is managing to convert its earnings into cash. This is a very important ratios that investors should look at when they analyze a company, because if what the profit the company is earning is not getting converted into cash, and the cash that has come into the business is excessively invested into its investing activity like purchasing of fixed assets. So whenever a company does excessive investment in its fixed assets over what it earns, then it means it has to borrow more money through the financing activity, which basically means that the company will have to pay more interest, reduce profit. So it's all a cycle which takes company into more debt and more borrowings. So let us look at the profit of the last 5 years. This is the total profit that the company has earned over a period of 5 years. Tata Steel's profit is just 40 CR. JSW Steel has managed to earn 12,900 CR over a period of 5 years. Kalyani Steel has earned 526 CR. SAIL had losses in the last 5 years of 3,066 CR, whereas Welspun has managed to earn 443 CR of profits. Now, why is Tata Steel's profit so less? This is because the company's investments in fixed assets is huge, because of which they have to provide for high depreciation cost which directly reduces the profit that the company has earned. But we have to then understand what is the cash conversion of that profit. So we see that the company has earned huge cash of 55,328 CR over a period of 5 years. Now, why is there a major difference between what the company has earned as profit and the cash? Is because of the depreciation. The company's depreciation expenses are huge, because of which its profit is basically falling at a drastic pace. Although depreciation is a non-cash expenditure, it reduces the profit but doesn't reduce the cash. That is why understanding the cash flow statement is so important for the investors. JSW Steel has managed to convert most of its profit into cash, where it earned a profit of 12,000 CR. Its cash coming in was 37,000 CR. So this is what we want to look at when we analyze a company, that it should not be, the profit too should not be very low and the cash flows should not be very high. There should be a balance between the two of them. Same is the case for Kalyani Steel. It earned a profit of 526 and a cash of 658, which shows how prudently these companies are investing in their fixed assets. We don't want excessive growth rate in a company which could derail the future growth or the future prospect of the company itself. SAIL had a loss over a period of 5 years of 3,066 CR, but it had a cash earning of 20,709 CR. This too we would not want to see, where the company on one side is making a losses and on the other side they are making a cash gain or cash profits. So when we see a negative profit or a very low profit in the case of Tata Steel and a high cash flow like in SAIL and Tata Steel, it means that the company is investing heavily into its businesses, and if that investment doesn't work out, then that would backfire on the company and create havoc with its working capital requirements, as well as it may turn it into a big problem where it may even have to close down because of bad investments. Welspun Corp had a 443 CR of profit, but it had a cash flow of 2866 CR. Now we'll look at the cash flow to PAT percentage. We see here that the Tata Steel had the highest percentage return of almost 1,363 times more than its earnings. The cash coming in was 1,363% or times of the earnings. We don't want to see such high figures or even a negative figure like this. JSW Steel had 2 times its profit coming in as cash. That is, cash was almost 1.8 times of its earnings. Kalyani Steel had a almost balanced cash to profit ratio of 0.2% or 0.2 times. Out of the profit earned of 526, company's cash coming in was 658 CR. This is a very balanced figure that we can look at. SAIL had a negative CFO to PAT because the company had losses, and when we divide the PAT by cash, we get a negative percentage. So we don't want to look at a negative rate or a very high difference between PAT and CFO. Welspun Corp had a 5.4 times more cash coming in than its earnings. In terms of free cash flow, that is, out of the cash flow from operations, how much was used up in investing. Here we don't want the cash flow getting completely emptied out and majority of that getting invested into fixed assets. If the company has to grow, it has to grow at a reasonable rate, and if the company is investing too much into its businesses, that is basically a thing that investors should be cautious of, because many companies have gone into debt and debt trap because of high growth rates in the company. Tata Steel's cash, which had come in at such a high rate at 55,000 CR, out of that only 2,400 has remained with it. That is 95% of that has got emptied out into its investment activity. That is why I say that the free cash flow should be at least 50% of the cash flow from operations. That is, whatever the company has earned in cash, not more than 50% should be utilized in buying of fixed assets. A very high investment in fixed assets can backfire sometimes, or most of the times, in fact. JSW had invested 50% of its cash into its fixed assets. So this is a good rate that we should look for. Even Kalyani Steel has managed somewhere around 50% of investment activity from whatever cash it earned. So here we can see the company had earned a cash of 658 CR, whereas it had a free cash flow of 347. That is, a balance amount between these two was utilized in buying of fixed assets, which basically translate into 47% of 658 invested in buying of fixed assets. SAIL had invested in excess of what it earned as cash. So we see here that although it had losses and it had a positive cash flow of 20,000 CR, but it had a negative free cash flow of 10,896 CR, which means whatever cash it earned, that it has invested back into buying of fixed assets. Not only that, over and above the cash, it has invested additional 10,000 into its business. This excessive investment will definitely backfire for the company if whatever it has invested in doesn't give returns to the company. So we see it had a very high negative outflow in terms of cash from operations. Its cash from operations was not enough to cover up the investment activity of the business. So in this case, the company will have to borrow more funds from the financial institutions and banks, which will increase its debt liability. Welspun Corp only invested 21% of its cash from operations into investment activity, and the balance was lying free for financing activity like paying off dividend or acquisition or buyback or bonus or whatever the company wants to do with the free cash flow. So in terms of 5 years, we see that JSW has managed to convert maximum of its profit into cash at 1.8 times, whereas SAIL had a loss in 5 years, because of which it had a negative value in CFO to PAT. In terms of free cash flow, the minimum investment was by Welspun at just 21% of its cash flow from operations, whereas SAIL has invested in excess of what it earned, 1.5 times over what it earned into buying of fixed assets. So this is not a good sign. Next, let us look at the annual values of the profit that the company has earned and how much of that got converted into cash. We'll also compare the last 12 months earnings or profit after tax value with its average of last 5 years. So this helps us understand how the company has done in the recent 12 months compared to its average of 5 years. And then we'll also compare the recent 12 months earning with its previous year's earning and see whether there is a growth or a fall in profit. Then we'll look at how last year's profit was converted into cash and at what percentage rate it has got converted. So we have 4 values for which we will have 3 different ratios. So in total we'll have 7 ratios to look at one go. Tata Steel on average was making a profit of 8.1 CR every year, whereas in the recent 12 months its profit was 9,118, which was very good because it's way above the average, and this is the profit that it should show, as well as the conversion of this profit into cash. Last year it made a profit of 5281 cr, and its latest profit is above the previous profit. That is, there is a growth rate in profit, YY growth rate in profit, which was 72%. So from 5,200 to 9,100 works out to 72% growth rate YOY. When we look at the last 12 months profit in terms of its, again comparing it with the average, that would of course translate to a very high percentage gain, which does not make sense, because the average profit of the last 5 years was just 8 cr. Now if you look at the last 2 years profit, we see that the profit rates were very high here. Then how come the average is just 8 cr? That could be because in the previous 3 years the company may have made a substantial losses, because of which the average PAT has fallen to just 8.1 cr. Next, let us look at how much of this profit of 5,200 has got converted into cash last year. So we see a good conversion rate of from 5,200 to 8,000 at a reasonable growth rate of 51%. That is, more than 51% of the PAT has come in through cash. So in the last 2 years, it seems that the ratio for the company has, in fact, the values for the company have come up for better. Next, let us analyze JSW Steel for the last year. Its average profit was 2,598 cr, whereas the recent 12 months profit is 7,500, which is above the average. So this is a good sign. We want the current 12 months profit to be above the average of last 5 years. So it is above by 190%. This is a good value. Second, we'll look at how the profit has grown from previous year to the recent 12 months. Here too we see from 6,492 cr it has grown to 7,551 cr. That is a growth rate of 16% year on year. This is again a good value. We want a 10% growth rate YOY. Finally, we'll look at how much of the profit of last year got converted into cash. So we see almost cash was double of the earnings, which is like 90% of the, more than 90% of the profit has come in by way of cash. So all these ratios are good for JSW Steel. In the last 5 years, even for Tata Steel, in the last 1 year, the values for Tata Steel have also improved for good. Kalyani Steel's average profit was 105 cr, and in the recent 12 months it has earned above the average at 123 cr. That was a 17% gain above the average. Year on year growth rate from 114 to 123 was 7.8%. The company has managed to get a gain of 7.8% year on year in profit. In terms of cash conversion too, the company has done well. Out of its profit of 114 cr, its cash earnings were 192. That is 67% higher than its profits. So this is again a good value for Kalyani Steel. Next, let us look at SAIL. Average loss was 613 cr. In the recent 12 months, the company has turned around for better, and it has earned a profit of 2,433 cr. A year prior to that, the company had made losses of 435 cr. So you can see that the company's recent profit is above the average, which is a good sign for one, and it has also gained from its previous year's losses. So that is again a second good sign. Third, whatever losses the company had made, it had a positive cash flow. So even the company showed a loss of 435 cr, because the company had negative values in its average PAT as well as the last year's profit, the ratios would almost be zero, because we will not get a proper growth rate value because the base price is negative. So that is why we'll just give it a score of 1 for all of them. Welspun, on the other hand, had an average profit of 88 CR and recent 12 month had a loss of 18 CR. So this is a problematic area for the company as well as for the investors, which need to check whether the company is making any losses. So in the recent 12 months or 4 quarters, it had made a loss of 18 CR. A year prior to that, they had a profit of 151 CR. Against that, they had a conversion of cash was 981, which is a good conversion rate. So we had a profit after tax of 12 months and we saw that it has fallen at the rate of 120% below its average PAT, which is not, we don't want to see a negative or a profit of the 12 months falling below the average. Not only that, we see that from the previous year, the company has made losses. So that's a degrowth or a fall in profit at the rate of 112%. So it will get a negative score here as well. And in terms of cash conversion last year from profit to cash, that was a good conversion rate of 5.4 times or 546% basically. So in terms of growth rate above the average, JSW has managed to gain 190% above its average profit, and Welspun had a loss. Its average profit was 88 and it had a loss in the recent, so basically it has fallen even below the average and has made a loss. The year on year growth rate in profit was highest for Tata Steel. From 5,200 it has managed to earn 9,100 CR in the recent 12 months. So the highest growth rate year on year for the profit. And in terms of losses, Welspun has made a loss of 112% over its previous year. In terms of conversion of profit into cash, JSW Steel has done the best by converting 90% over its earnings. And the lowest was Welspun, or I would say the lowest was Tata Steel at 51% because SAIL had a negative average profit, or in fact it had a loss in the previous year, and the current year it had made a big profit of 2,433 CR, but the calculation cannot be done because the base price is negative. So we've just given a score of 1. Here I would say Tata Steel would be the lowest cash flow to profit converter. Next, we'll look at how the company has managed to grow its sales and profit quarter on quarter and year on year. That is from March 2018 to March 2019 YOY, and from December 2018 to March 2019, that is QOQ, quarter over quarter. So look first for year on year sales growth rate. Here we want the sales to grow every quarter at least at an average rate of 10%. Tata Steel has grown at the rate of 25% over its previous quarter of March 2018. So that's a good sales growth rate. JSW has managed 4%. Kalyani Steel's sales has dropped at almost 10% from its previous quarter. SAIL has managed to grow at 8.6% and Welspun has grown at 115%. Let us look at the near quarter on quarter growth rates from December to March. Tata Steel's sales has grown at 9%, JSW at 10%, Kalyani Steel had a fall of 13% over its previous quarter. SAIL has grown at 16% and Welspun at 14%. So we see Kalyani Steel not doing well in the recent 1 year. Let us look at the profit growth rates. Tata Steel has made a loss, or not a loss, but the profits have fallen by 38% over the previous quarter. Although its sales have grown, its profits have fallen. Same is the case for JSW Steel, where its sales have increased by 4% but the profit has fallen by 48%. But Kalyani Steel, the case is different. Although its sales has fallen at the rate of 9%, its profit has grown at the rate of 22%. This is what we should look for, where the sales are also growing and the profits are also growing. In this case, Kalyani Steel's profit has fallen by 9%, but profits have grown at the rate of 22%. SAIL has managed to grow its profit at 8%, but the profit has fallen at the rate of 9%. So most of these companies, although their sales have grown, the profits have dropped considerably, except for Kalyani Steel, which managed to gain 22% in its profit. Welspun Corp looked the same, 115% growth rate in sales, but 1853% drop in profit. Very poor. Let us look at the recent quarter on quarter profit. In the recent December to March quarter, Tata Steel has gained 30% in its profit. JSW has again had a fall in its profit of 6% from its previous quarter. Kalyani Steel managed to gain 18%. Although sales had a negative drop, sales had fallen, but the profit grew by 18%. Sales increased quarter on quarter by 16%, but the profit fell by 24%. We don't want to look at this kind of figures, or we don't want to see this kind of figures when we analyze, and we would not want to invest in such companies, or at least wait for these values to turn around before we invest. Welspun Corp sales have increased quarter on quarter by 14%, but the profit fell by 634% over its previous quarter. The highest sales growth was seen in Tata Steel year on year, and the highest fall in sales was seen in Kalyani Steel of 9%. Quarter on quarter also, Kalyani Steel fell by 13%, whereas SAIL managed to grow its sales at the maximum rate of 16%. In terms of profit, Kalyani Steel has managed to gain the highest profit growth rates of 22% and 18% YOY and QOQ, whereas Welspun had the worst profit fall in its recent quarters. Next, let us look at the net worth of the company, or the actual value of the company. This is the total book value of the company after the company clears all its liabilities by selling all its assets, and whatever remains goes to the shareholders. So in terms of net worth, we see that Tata Steel is huge at 68,000 CR, followed by SAIL at 38,000 CR and JSW at 34,000 CR. The other two companies are small cap companies, Welspun Corp at 2,700 and Kalyani at 890. Kalyani Steel is the smallest of the group companies, and the largest or the biggest in terms of net worth is Tata Steel at 68,000 CR. Next, we'll look at the contingent liability. This is the liability which may or may not arise in the future, and there are no provisions or entry made of these liabilities in the balance sheet. So we have to be careful that the companies don't carry a very high contingent liability against its net worth. In this case, I like to keep the contingent liability at 20% of the net worth. So we have the ratio here. So when we look at most of the companies' sales, contingent liability is 70% of the net worth, which is very high. The net worth is 38,000 CR, whereas contingent liability is 26,000 CR. Tata Steel, contingent liability is 22%, slightly above our benchmark. And Welspun Corp's contingent liability is also very high at 51% of its net worth. So we don't want to invest in companies which have a very high contingent liability, for which possibilities are there that those liabilities which are not accounted for in the financial statements may arise in the future. And since the companies have not done any provisions for it, it may directly affect the profit of the company in the future. Next, we'll look at the debt to equity ratio of the company, and also look at the other two ratios like interest coverage and debt to profit. Let me explain each of them individually. The debt to equity ratio basically measures what was the company's borrowings or how much the company received funds through borrowing activity and how much was contributed by the shareholders. Now, if the debt or the borrowings is very high, the company will also have to pay more interest against that borrowings, which would ultimately reduce the profit that would come to the shareholders. So we want a balance between the borrowings and the shareholders or owners' contribution into the business. If the company wants to grow at a high pace, then it may have to do borrowings, but they can do the borrowing but at a reasonable rate of interest. So even if the debt to equity goes above 1, which is our benchmark, even if it goes above 1 but the company is borrowing at a very reasonable rate of interest, then we can even allow that to go above 2% till the time the coverage is good. That is, the company is easily able to pay its interest on its borrowings. So that will be covered by the interest coverage. Here we use the EBIT or the operating profit and we divide it by the interest, which then gives us for how many more years can this year's EBIT cover future years interest cost. Here we want the interest coverage to be at least for 4 years from this year's profit. That is, this year's profit should be able to easily cover the future 4 years interest payments. Finally, we'll look at the debt to profit. This ratio measures what is the current year's profit and what is the total borrowings. So here we don't want the borrowings to be at a high multiple of the current year's profit. In other words, we can understand with this ratio whether this year's profit will be able to clear off its borrowings within how many more years. So here too we want the ratio to be as low as possible. So let us begin with the debt to equity. We want the debt to equity to be below 1 times. Tata Steel had a debt to equity of 1.32 times, which is high, and its coverage has fallen below 4 times. Now the coverage is just 3 times. That is, current year's profit can cover only 3 years of future interest payments. Now these benchmarks are my own set. These are the benchmarks that I look at. It is not necessary that this is a standard benchmark. Each individual, as per their comfort level or their risk level, can set their own benchmark. I feel 4 years is a good coverage from this year's profit. JSW also had an equal debt to equity ratio of 1 times, and its coverage too was very near 4 times. The current coverage is 3.85 years. Kalyani Steel didn't have any debt, which is the best part of it. Therefore, whatever profit it earns nothing goes into the coverage. So we have the highest coverage for Kalyani Steel. SAIL also had a high debt of 1 times, because of which the coverage has fallen to 2.18 years. Now the company's interest cost may be very high. It is very similar to Tata Steel, where its debt is 1.32 times its equity, but coverage is high. Whereas SAIL's debt to equity is even lower, but its interest coverage is even lower. So which is not a good ratio to look at for any investors. Welspun Corp's debt was 0.45, yet they didn't have any coverage. Their coverage was just 1.4 years of the future interest payments. So even though the debt is low, still the company is not able to cover its interest cost. This is due to losses that the company is making in the recent years. Finally, we'll look at the debt to profit, how far the debt is compared to this year's profit. Tata Steel's debt is 6 times more than the profit. Here too we want the value to be as near as 0. Here the company, in other words, if I have to explain, the company will take 6.7 years to pay off its borrowings using current year's profit. So this ratio gives us a very good idea as to how fast the company can pay off its debt or total borrowings. JSW will take 5 years to pay off all its borrowings from this year's profit. Since Kalyani Steel didn't have any borrowings, it doesn't have to worry about the same. SAIL had a negative year. That is because this year's profit, in fact this year they had a loss, so this ratio itself would be not applicable here in this case. And Welspun Corp had a 7 years to cover or clear off its debt using this year's profit. Kalyani Steel had the lowest debt, or in fact had no debt at all, and Tata Steel had the highest debt in the group companies. In terms of coverage, Kalyani Steel had the highest coverage since it had no debt, and Welspun Corp had the lowest coverage of just 1.4 years. In terms of debt, Kalyani Steel again has to be the best because there is no debt compared to the profit, and SAIL, since it had a loss last year, has performed the worst. That it means it will take many years just to cover the debt because the company is making loss last year. So many of these ratios use the recent year's earnings to calculate the ratio. Some of them use 5 years average, and we also have a few ratios which look for growth rates from 5 years and from 3 years. So we have a mix of ratios which will look at different years and different variables. So we have a complete picture of how the company is doing over different durations. Next, we'll look at the change in promoter holding over a period of 3 years, from where it was 3 years back and how it has been now. We'll also look at the current promoter holding of the recent annual statement, and then we'll look at how much of the promoter holdings have been pledged with financial institutions. We don't want the company's promoters to pledge their shares at a high percentage rate. Here my benchmark is 20%. Even if the promoters have pledged 20% of their shareholding, it is still okay, but it should not exceed 20%, because if the promoters pledge a very high percentage, then it is as if they have already exited the company, and we don't want to be invested in a company where the promoters have exited either by directly selling the stock or by way of pledge. The pledge is as good as a promoter exiting the company. So we see Tata Steel, since many of these change in promoter holding from 3 years are not showing correct values, will ignore Tata Steel and JSW's growth rates in promoter holding. Kalyani Steel promoter holding has grown at the rate of 4% from where it was 3 years back. SAIL's promoter holding has not grown at all, and Welspun's management have increased their stake by 7.9% from 3 years back. So for time being, we'll just ignore this promoter holding and will not assign any ratings to this particular ratio. Let us look at the current promoter holding. This is as per the latest shareholding filing with the BSE and NSE. Tata Steel's promoters hold 33% in the company. JSW has holding 42%. Kalyani Steel promoters hold the highest 64% stake in the company. So the more the promoter holding, the higher is the incentive for the promoters to work for the well-being of the company, and in turn it directly benefits the shareholders of the company. SAIL, which is a government company, government has a stake of 75% in the company, and Welspun promoters are holding 48% in the company. But in terms of pledge, Kalyani Steel, SAIL and Welspun has no pledge, whereas JSW's promoter have pledged 46% of their holdings with financial institutions. This is a very high value. As I said earlier, our benchmark should be 20% and not anything above that. Tata Steel promoters have pledged only 3%, that is also alright. Let us look at the debtors to sales ratio. This ratio basically measures the total accounts receivable from whom the money is still pending to be collected, or basically we can also say from the customers from whom we have to collect the payment, or the company has to collect the payment against this year's sales. So what we are trying to understand is, when whatever the company has done sales of this year, how much of that sales as a percentage was still pending to be collected from the customers. Tata Steel's debtors to sales percentage was just 7.26%. Here we don't want the ratio to exceed more than 30%. The highest debtors or money to be collected from the customers was seen in Kalyani Steel at 25%. That is, when compared to this year's sales, 25% of the sales was still pending to be collected from the customers. Rest all the other companies have done well to keep it at a low value of below 15%. In terms of debtor days, that is how many days the company is taking to collect payment from its customers. This is again a very important metric to look at, as it shows efficiency in collection from the customers. Tata Steel is taking 34 days, JSW is taking 24 days. Kalyani Steel again has the highest collection days. It is giving its customers 102 days to pay back to the company for the goods that they have purchased on credit. SAIL is taking 24 days and Welspun 63 days. So we want this value to be below 90 days. That is, the maximum credit a company should provide to its customers is 90 days or 3 months. Let us look at how the company had performed 3 years back. 3 years back too, company was giving 34 days to collect payment from its customers. Tata Steel. JSW was collecting payment in 17 days. Kalyani Steel was high even 3 years back at 97 days, and it has gone up to 102 days, slightly above where it was 3 years back. So this particular ratio helps us understand how the company has improved its collection period. SAIL is also at a very similar range where it was 3 years back. Welspun's current debtor days is 63, whereas 3 years back it was 48. So we want these values to be below 90 days. In terms of debtors to sales, debtor days and debtor days 3 years back, we see Kalyani Steel has done very poor in its collection of payment from its customers. Not only it is taking 102 days to collect, but 25% of this year's sales is pending to be collected from the customers. JSW has done well in keeping its collection period at a very low period in the peer group companies. In fact, it is collecting at the fastest rate. In terms of lowest debtors or the lowest collection of customers pending to be collected was from SAIL at just 6% of its sales of last year. Next, let us look at the inventory and how that inventory was turned over into sales, and how the inventory was turned over into sales 3 years back. So this gives us an idea as to how the company is managing its inventory and how fast it is converting inventory into sales. Tata Steel had a current inventory holding and its sales of this year was 4 times or almost 4.9 times higher than its inventory holdings. JSW managed to convert its current inventory holding 5.8 times into sales. Kalyani Steel has done the fastest conversion of 10 times of its inventory holdings into sales. Now, these values can be slightly misleading. If the company's inventory holding itself is very low, then the value will inflate to a high double digit or a single digit. SAIL has managed to convert 3.4 times its inventory into sales. These are the latest value of inventory to turnover, and Welspun has done 4.6 times conversion. Let us look at how the inventory was 3 years back, how inventory was getting converted into sales 3 years back. If you look for Kalyani Steel also, 3 years back also it was doing 8.9 times over. Other companies were converting at around 4 to 5%, and SAIL had a very low conversion rate of inventory into sales. If you look at the other way around, we can also say whether the current inventory holding is very high for the company or is it at a reasonable level in terms of sales of this year. So this helps us understand whether the company is managing its inventory efficiently or not. Let us look at the 5 years operating profit margin rate. This is the top line profit growth rate that we are interested in looking at, and it should be at least above 15%, because out of this operating profit there are other expenses to be deducted like interest cost, any contingent liabilities, or any contingency which may come up, extraordinary items, taxes, interest cost, depreciation, and so on. Tata Steel's OPM was 8%. JSW had a good OPM margin of 19%. Kalyani had a 16% of OPM over a period of 5 years. And other two companies have done poorly like Tata Steel, managing below 10%. Let us look at the net profit margin of the company last year. We want the NPM to be at least 10% and above that. Only Tata Steel has managed to keep its recent net profit margin above 10%. JSW and Kalyani has fallen short of 10% by a small margin. SAIL had a net loss last year of 0.84% of its sales, whereas Welspun had a very small profit growth of 2.1%. Let us look at the previous year's net profit margin values. Tata Steel previous year had made a net loss of 3.78% on its sales. JSW had managed to have a margin of 6% on its sales. Kalyani Steel did the best in the preceding year by earning a margin of 12%. SAIL also had a loss even in the previous year. Last year it had a loss of 0.84%. A year prior to that, it had made a loss of 6.3% on the sales. Welspun Corp also didn't do well, and the margin was just 0.45, which is next to negligible. So when we analyze the OPM and the NPM of the recent year as well as the last year, we see that in terms of OPM, JSW Steel has done the best of earning 19%, and SAIL has done the worst OPM of just 4.23%. In terms of net profit margin, Tata Steel has done best in the recent year of earning 10%, and none of the companies have managed to grow their net profit margin above 10%. The worst in this case, SAIL had a loss of 0.84%. A year prior to that, the best margin was of Kalyani Steel at 12%, and SAIL again had a very poor net profit. In fact, it had a loss of 6.3% in a year prior to the current year. Next, let us look at the next three ratios and complete our analysis. The current ratio, which measures, basically it's a liquidity ratio, and it measures the company's ability to pay short-term obligation by selling its current assets and paying off its current liabilities. Generally, this ratio is not used until the company has to be liquidated and closed. So this ratio is just a understanding of how the company is managing its assets and liabilities, whether it can pay off its current liabilities, that is those liabilities which can arise in this year, using the current year's assets or assets which can be sold in the current year. Tata Steel's current assets are not enough to cover its current liabilities. They are still falling short by 0.92%. That is, the company can only clear 92% of their current liabilities using the current assets that the company owns. Here we want the ratio to be at least 1 or above that. JSW Steel's current assets are not enough to cover its current liabilities. Even if the company has to clear of its current liabilities, they can do only 80% of that. Kalyani Steel had a good coverage of 1.78 times its current liabilities. That is, it can easily pay off its current liabilities using by selling off the current assets. SAIL would again fall short by 77%. That is, only 77% of its liabilities can be cleared off, current liabilities, using the current assets. Welspun had a good coverage between the assets and liabilities. Now let us look at the quick ratio. This too is a liquidity ratio, but here we are looking at very liquid assets which can be sold off and clear off the current liabilities. Most of these companies which had fallen short will fall further short because here we are not considering all the current assets. We are just considering the most liquid current assets like cash or debtors, by maybe debtors, or we're not even considering the debtors. We are just considering the investments which can be sold off easily. So if we look at the quick ratio, we see Tata Steel is not doing very well in terms of managing its current liabilities. JSW Steel will also fall short. Kalyani Steel has a good coverage of 1.43 times. SAIL will also not do well in clearing its current liabilities. And Welspun's quick ratio has fallen down to 1 times, which is still good, that it can at least clear of its current liabilities using quick assets. Finally, let us look at the dividend yield. This is the yield as per the latest annual statement, and we are using the current price to come to the yield that the company has provided. Most of these companies are providing dividend except SAIL, which since it had a loss cannot give dividend. This is an added bonus that shareholders get for taking the risk of doing investment in the shares of the company. This is an additional bonus other than the growth in the share price of the company. This is not a very critical part, but as investors, if we do get an additional dividend other than the growth in the company, that's always welcome. Now this concludes our analysis of these companies. So in terms of these three ratios, Kalyani Steel has done the best by having a good coverage for current as well as quick assets and liabilities, and also paying the highest dividend yield in terms of its price. SAIL seems to have done very poorly in terms of covering its current liabilities, and even using the quick ratio, it has done the most poor. Also, in terms of dividend yield, it has not been anything in the last year. So that is why we've given it the lowest score. Now let us understand which companies got the highest score of the group companies. Kalyani Steel has got 95 points. JSW Steel has got 73 points. These two are good companies in terms of basic fundamentals that we have just covered. Tata Steel has got 52 points. Rest other two companies will have to ignore. So let us quickly go through Kalyani Steel's good points as well as the points which have been put as negative. Let us start with Kalyani Steel and do a quick analysis. Its 5 years historical price earning was very good, the lowest in the group companies. Its PG for 5 years was very good, that is the price earning multiple we are paying and the profit growth we are getting against that was the best. Its return on equity over a period of 5 years on average was the best. Return on capital employed was also the largest in terms of peer group. Return on capital employed was very good. Return on assets was the best. Return on invested capital was the highest. Now we'll look at what are the negative points. Its sales in the recent quarters have fallen by 9% and YOY and 13% QOQ. So in the short term, there is a problem in the company, which is clearly we can see from here. But in terms of profit growth rate, it was the highest. Although the sales have fallen at high rates, the profits have grown also at a high rate. In terms of contingent liability, it has the lowest contingent liability, no debt, highest coverage, again no debt compared to the profit. Let's again look at the negative aspect of collecting payment from its customers. Its debtors were 25% of its sales, which is high but below 30%. So this I would still not consider it as a negative. The debtor days have of course gone up above 90 days, so this is negative. Even 3 years back, it was taking 97 days to collect money from the customers. So in terms of that, it has marginally moved up from 97 to 102 days. In terms of net profit margin of the previous year, it has done the best. Current ratio, quick ratio is the best of the lot, and dividend yield also is the highest. So we see that most of the points for Kalyani Steel are positive. Let us quickly look at JSW Steel and see how the company has performed. JSW Steel's book value was the highest in terms of peer group, but it was below 2.5 times. Its market cap was the lowest, that is, sales were higher than the market cap. Its PEG was best for the last 3 years. Sales growth rate were very high for last 5 years and 3 years. Even return on equity of the latest year was the highest. Its cash conversion, earnings into cash conversion, was the highest in last 5 years, earning 189% more than its profits. In recent year, its current profit has grown 190% above the average, so it has earned a very high growth rate in profits. Again, in the 1 year comparison, its profits are getting converted into cash by 90% above its earnings. That is, the earnings were 6,400 CR, whereas cash coming in is 12,000 CR, which is the highest in the group company. We want to see a high conversion of profit into cash. But there was a problem in this company, that the promoters have pledged 46% of their holdings, and that's absolutely not a good sign. So we have to stay away from companies which have invested or which have pledged a very high percentage of their promoter holding. Debtor days are the lowest for both 3 years back as well as currently. So it's collecting payment from its customers at a very fast rate within very few days. Its OPM also has been highest over a period of 5 years. But now the only problem with JSW Steel is the pledge part, which would again derail the whole valuation that it has got at 73 points. We don't want a very high pledge. This is a critical part. We have to understand, in case we want to invest in this company, what is the pledge, or for what duration the company's promoters have put this pledge, and what are their intentions on clearing this pledge, how soon will they be clearing this pledge. We have to also look at how quarter on quarter the pledge have increased. Is this pledge stable from many years, or has it just been increasing to 40 to 46% recently? So I would be little cautious in investing in JSW Steel, because the promoters have pledged or exited half of what their promoter holding was. We can also look at Tata Steel quickly. Tata Steel is down the lowest of the group company, just fallen 21% from its 52-week high. That's a positive. It has the highest earning yield as of the 12 when compared with the 12 months of earnings. Its last year's price earning multiple was the lowest, available at just 6 times, recent 12 months, and even last year it was available at the lowest price earning multiple of 4 times. When we look at 3 years historical, it was 4.4 times. Price to OCF is the worst in the group company. That is, it is available at 7 times its OCF. Also, although this is a positive value because it is way below 25 times, but when compared with group companies, it is trading at the highest price to OCF. Its profits have grown at the rate of 72% from its previous year, which is a good sign. Its quarterly sales is the highest at 25%. This is YOY growth rate. It is the largest company in the peer group comparison. There's a problem here that its debt is very high at 1.32 times its equity contribution, because of which it has a very low coverage of 3 years. Generally, we want at least 4 years of coverage. Promoter holding is 33%, which is the lowest in the peer group companies. And they have done a mild pledge, but it's negligible. And net profit margin is 10% in the last year. So many of these are positives, I would say. Even the debt to equity is alright, it's high, but they still have a coverage of 3 years. That is a good sign. This has improved considerably because of the current 12 months earnings earnings, as well as the last year's profit that the company has earned, because of which there has been a turnaround in Tata Steel's fundamentals. So this concludes our analysis of the companies which were into steel sector. Thank you for watching this video.